Hey everyone, welcome back to Corporate Decoder. Today we're diving into VolitionRx's latest report, and let me tell you, it's a bit of a roller coaster. Buckle because there might be more red flags than a communist parade. This report gives us a peek into how VolitionRx, a company trying to revolutionize disease diagnosis with simple blood tests, is doing. Are they making progress, or are they running out of gas? Let's find out. If you appreciate getting straight insights from corporate documents, make sure you're subscribed and come join our Discord community. The link is in the description below. Alright, let's jump right in. First off, this is a Form 10Q, which is basically a quarterly checkup for publicly traded companies. It gives investors an update on their financial health. VolitionRx is listed on the NYSE American under the ticker symbol VNRX. They're selling common stock, the most basic kind of stock a company can offer. As of May 7, 2025, they had about 103 million shares of stock out there. This number is important because it affects things like earnings per share, which we'll talk about soon. Now, before we get too deep, it's important to remember the forward-looking statements disclaimer. This is where the company says, hey, we're making predictions, but things might not go as planned. Basically, don't take everything they say as gospel. Here they point to a few major risks, like not making enough money, needing to get more funding, and depending on other companies to sell their products. Those all don't sound great, to be honest. They also mention the possibility that they may not be able to continue to operate, which is a pretty big red flag. It's auditors giving going concern opinion. This basically saying there is a big risk the company can go bust. Outside tab are the numbers, the part everyone cares about. First, the balance sheet. This is like a snapshot of what the company owns and owes at a specific point in time. It looks like they're owed about $188,000, which isn't a huge amount. It's money they're expecting to receive but haven't gotten yet. They have about $4.3 million in property and equipment, which is down slightly from the end of last year. This includes things like lab equipment and buildings. Now for the liabilities, they owe about $3 million in accounts payable, which is money they owe to their suppliers and vendors. Their long-term debt is a bigger number, over $5.5 million. This is money they've borrowed and have to pay back over a longer period. Long-term debt went up quite a lot compared to December, which had $39 million. That is something to look out for. They have an accumulated deficit of nearly $235 million. This is the total amount of losses they've racked up over the years. Now let's move on to the income statement, which shows how much money they made and lost over the last 3 months. Their total revenue for the last 3 months was about $246,000. While it's an increase from last year, it's still a pretty small number for a publicly traded company. They spent about $2.6 million on research and development. The general thought process is that it is good the company cut their R&D expenses. That is a clear sign the company is struggling. Sales and marketing cost them about $917,000. This is what they spend to try to get people to buy their products. They paid about $97,000 in interest expenses. This is the cost of borrowing money. Their net loss was about $5.5 million. That's a significant loss, even though it's less than last year. You can see that this year isn't doing well to break out of the habit of losing money every quarter. That translates to a loss of 6 cents per share. This is what investors care about because it shows how much the company is losing on each share of stock. Next up is the cash flow statement, which tracks the movement of cash in and out of the company. They used about $4.3 million in operating activities. This is the cash they burned through from their day-to-day business. On the other hand, they got about $3.7 million from financing activities, which includes things like selling stock and borrowing money. They had to get money from an outside source to keep their company afloat. They lost around $31,000 due to exchange rates. This is a common risk for multinational companies. Their cash and cash equivalents at the end of the period were about $2.6 million, so they might not have that much runway without another cash infusion. Here they acknowledge that there is substantial doubt about their ability to continue as a going concern. This is a serious warning to investors that the company might not be around for the long haul. One thing that they value on level 2 is the warrant liability, which is how much money it would take to buy back their own warrants. Their value went down. They mentioned taxes relating to their own compensation, which is an outflow of $24,000. It's not much. They issued over 4.5 million shares for cash. This brought them some money, but it also meant there was less value for those that had their own shares before that. Another thing is the total remaining unrecognized compensation costs related to stock options is 0, which is always good. People always want to look at it and make sure there isn't that much money going out the door. They sold some common stock, bringing in $243 million, but also paid out $24,000 in tax withholdings. Now let's talk about commitments and contingencies. This section covers things like lease obligations and legal risks. Here they talk about people with restricted stock who have left a company and thus forfeited their options. They have some other commitments like the expenses for managing director agreement or long-term debt. There was a recent debt agreement effective May 15, 2025. We entered into a securities purchase agreement. So the company expects to receive $650,000 in funding from Lind in exchange for the issuance to Lind of a senior secured convert from dollar promissory note and a common stock purchase warrant. And we're going to look at that. It's something that they will need to pay back later in time, top case warrant, and we're going to look at that. It's something that they will need to pay back later in time. Okay, so what's the verdict on VolitionRx? They're in a tough spot. On one hand, they're trying to develop innovative technology that could really help people. And, well, that's about it when it comes to good news. They are not making much money. They are burning a lot of cash, and they themselves have serious doubts about whether they can continue as a company. They depend on external companies to make any profit. They are drowning in red numbers. It's hard to justify any target price with what we're seeing. I would recommend staying away. Alright, that's our breakdown of VolitionRx's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.